And hello there, everyone. This is Scott Welsh, and this is the Beating the Market video for today, Thursday, May 3rd, 2018. Well, we talk about beating the market on this channel every week, but today we're going to actually talk about why we don't beat the market. We can, but we don't. And we're going to talk about it. Three things today. Number one, as I just mentioned, we should beat the market. There is no reason why all of us can't do better than an index fund. There's no reason why we should not beat the market. But we don't. What are those figures? 90% don't do it. 95% don't beat the market. 96% of mutual funds don't beat the market. Seems like nobody beats the market, but we should beat the market. So why? Well, that's number three. We're going to talk about why. And is it fixable? We're going to talk about that too. All right, here's a shot of me. I get a little bit cranky when I talk about not beating the market. This is a shot of me. Someone took a photo. They said, hey, you can't beat the market. And that was my face. So hopefully you get to know me, and that helps you and I bond together. All right, here is why we should beat the market, all of us. The number one reason is the markets are not efficient. Everything is not priced in. Things go crazy. Things go haywire. Trends happen and they persist longer than they should. Things are not normal or on a normal distribution curve or not priced in a normal, reasonable manner. The markets are not reasonable. Frankly, they're not even close in extreme times. Sure, on a quiet day, maybe the price of iPhones is priced into Apple, maybe if nothing's going on. But there are so many opportunities because of inefficiencies, right? And if you don't believe me, we talked about it in the Wednesday newsletter this week. Take a look at a stock's 52-week high and a 52-week low. Well, if everything is priced in perfectly, what would you expect these numbers to be? Well, I'd say that for stock XYZ, the 52-week high should be about 100 and 52-week low should be about, 92. It's gotten a little crazy. We've made slight adjustments. I mean, stocks, for example, are real companies with real earnings and real products. You can't have $1 billion of value one day and $500,000 the next day. It can't fluctuate. Not unless a bunch of stuff is being stolen out of your inventories every single day. It's ludicrous. If everything is priced in, the 52-week highs and the 52-week lows should be pretty darn close. That's what efficiency means. But go ahead and take a look. They are wildly different. I talked about Amazon's in the weekly newsletter. They are 75% different from top to bottom. There's a 75% change. I mean, it's crazy. And that means there's inefficiencies. But don't believe that. Just take a look at a chart. If everything's priced in, we shouldn't see big moves up or big moves down, correct? Guess what you see? Big moves up and big moves down. And thus, if there are emotions and inefficiencies, a stock will be mispriced. Someone's too pessimistic, the price is wrong. The price is wrong, we can bet it back to fair value and make money. If people are too optimistic about Tesla or Netflix or anything else, and we think, they're expecting this many subscribers, but they don't get them, the price will wildly come down, and we can exploit. Those are stock examples. Same thing for futures. If orange juice prices are too pessimistic, we can exploit. If people think that certain economic news or certain decisions by the Fed will make the dollar rise and they don't, we can exploit. There are exploitations available to us on everything, right? Just look at the buy and hold on Forex, right? You can't buy and hold Forex because of the manic moves. You would think that currencies of all things would be the most normal, right? They're not dependent on day-to-day news necessarily. They're on major national economic policies and watch them go, right? You can't just buy and hold something. Well, you could, but it would be crazy, right? Forex swings wildly, and with the added leverage, it makes it even wilder, right? Or what in the heck is momentum? I mean, why does momentum exist? I've talked about trend following studies that go back hundreds of years. Surely, in hundreds of years of research, we would have found out that things are priced efficiently, and they're not. Trend following has worked for hundreds of years, and it shouldn't if things are efficient. Enough. Okay, I've made my point. I've made my point, right? Oh, and by the way, check out this, right? Look at Apple. Look at there on the left side, right? Let me get my little pointer. Is that efficiency right there? Look at that, straight up. Oh, what about that? Straight down, right? Anyway, like I said, you get my point. Now, if all those opportunities are there, then it begs the question, why don't we beat the market? Well, here's some interesting insight. And I love Joel Greenblatt. I just guest hosted Rob Booker's Traders Podcast, and we talked a little bit about Joel Greenblatt. He's got a lot of great information. Check out his books. Anyway, in the book, The Big Secret for the Small Investor, Joel Greenblatt talks about beating the market. And he says, if you're just going to do exactly the same thing as an index fund, you're not going to beat it. So to beat it, to get outsized returns, you have to do something different than the market. So if the stock market is up, you can't not necessarily go up. You should be zagging. Maybe you're flat, or maybe you even drop. If you're going to beat the market, you can't go where the market goes. You can't go up when it goes up, and you can't go down when it goes down. And because of this particular fact, it means we have to have a lot of patience. Think about it. If the stock market is up and your family members or investors or whomever comes up to you and says, hey, the stock market's going crazy, you must be doing great, and you're not doing great, that would be really, really difficult. All right, let's give an example that he gives in his book. And here's why average investors, meaning us, do poorly. All right, in 2000 to 2010, so a decade, right? And this had the huge crash in 2000, between 2000 and 2002. Remember that huge crash? It was something called internet stocks, remember? Anyway, that included that, and that decade wasn't that great from beginning to end. But in that decade, the market was flat. Well, the market actually wasn't flat, right? The market was down 24% for the decade. 10 years of trading, your count is now down 24%. Egads. But people who believe the market can be beaten were up 18%. In other words, the best active funds, remember, index funds are passive, meaning you just follow the market. You don't do any trading. You just put your money in and that's it. The best active fund managers were up 18%. So the market was down a significant amount, but active traders who believe the market can be beaten were up. There's the proof, everybody. Hooray, we've proved it. The market can be beaten because the market's not efficient. But whoa. Wait a second. The next line is crazy. In that same period, the average investor in that top fund, the one that was up, the average investor ended up losing 11%. Wait a second. The fund that they were in made 18%. And at the end, they lost 11%. Well, how is that possible? Here's how it's possible, and here's why we lose, and here's what we have to correct. The people who invested in that best active fund bought when it was going up. So they're like, the fund's going up. I better get in now. Now's a good time. And as soon as they bought, it had already risen, and it pulled back to the mean. Well, as soon as it pulled back to the mean, fund must not be hot anymore. They sold. So they bought near the high and sold much lower. Loss. Well, they say, okay, I'll just wait it out. When it rises again, then I'll get back in again. So they wait. It starts to rise. Well, I'm a little scared, but okay, I'll get in now. It's near the high and it goes down and you sell. And if you rinse and repeat that process, buying after it's gone up and selling when you're at a loss, that is a recipe for losing money in a fund or a strategy that makes money. The market is there to be beaten, and yet we won't beat it. And as Greenblatt said, it's astonishing to him that we do this as traders. But unfortunately, it's typical. We do this as traders. But that's not all, right? Remember I said that you have to have patience. You cannot do that manic buy when it's going up, sell when it's going down. You cannot panic if you have a sound strategy. A sound strategy is one that has been tested so rigorously that you trust it, or it just makes perfect common sense, like value investing or trend following, okay? Something that makes sense, that you can explain to others, that makes you feel good in your heart. That is a sound strategy, and it can be multiple things, but those are some examples. All right. Greenblatt did more study on institutional investors. And here is some data on the best institutional managers in that same period. Again, that was a tough decade, right? The top quartile, right? Quartile means top 25%, unless I don't know what I'm talking about. But the top quartile of the best managers, okay, I'm saying it slowly, the best investors, the best institutional managers, the top quartile for that decade. So here are the best. From beginning to end, they ranked as the best traders. They spent 3 years or more ranked in the bottom half of investors. So a third of the time, even though they ended up, okay, they ended up as the top. They ended up as the best of the best. During that journey, at least 3 years, they would have ranked in the bottom half. So you invest in a manager, or you are the trader, and you're going to end up beating the market, but 3 times at least in that decade of performance, you're going to underperform. You're going to be ranked in the bottom 50%. Would you stay around? I'm not done. Half of the top managers spent, so you take that top quartile and then cut that in half. Half of those top managers spent 3 years in the bottom 10%. Whoa! Think about that. So half of the best investors for an entire decade, at least 3 times, they were in the lowest 10%. Oh, great, the market's up. How did my fund do? Down in the bottom 10%. Oh, I've got a great strategy. See, family, friends, I've got a great strategy. It beats the market handily. Bottom 10% for 3 years. 3 of the years. Might be even consecutive. Holy moly, think about that. The strategy that beat the market handily 3 different years in the bottom 10%. And of course, as Joel Greenblatt says, nobody stuck with them. And yet again, that is how we don't beat the market. Do you see? That's the problem. If you're going to beat the market and do better than, 95% of the traders on earth, you have to underperform. Now that might be too strong. You have to be willing to underperform. Maybe you do great, all right? Maybe your strategy is even better than what we talk about. We're talking about some pretty powerful investors, but maybe you're better. You have to be willing to underperform all the way down to the bottom 10% of traders. You have to be willing to stomach that. If you're going to produce elite returns better than everyone, you have to be willing to lose while others are winning. Oh man, how hard is that, right? Amazing things can happen. The market can be beaten. We've talked about it ad nauseum. But If you're not willing to underperform, if you will not accept that and don't understand that, you will get out, I will get out, we all will get out, and we will not win in the end. Okay? As Greenblatt says, one of my favorite quotes, if you're cold and calculating, you can really take advantage of the market. The market is there to be beaten, but you can't be emotional. You can't sell at the top, right? You can't buy in at the top and sell at the bottom. You can't be emotional. Oh, my fund's going down. My strategy's losing. Out. Can't do it. You've got to be cold and calculating. Run an automated strategy or run a discretionary strategy that is ice cold, ruthless execution of rules. I mean, that's it. That's how you beat the market. If you want to win in the end, you have to play the long game. And if you're playing the long game, you might underperform, and that's okay. If you have a system, if you're a trader and you've built your own system, remember the quote, you have to be cold and calculating and make it through the bad times without a care in the world. Or if you do have a care, don't do anything about it. Be emotional, but don't actually press buttons or override your system. If we can do that, amazing is possible, beating the market and even better. If we're not able to handle that, if we're not cold and calculating, an 18% win for a decade can easily turn into a negative 11%, as the figures showed. All right, that's all for this week. If you want to look at any of my courses for right now, they're on kajabinext.com. I might move them over to my website someday. Who knows? Love for you to join the newsletter. Go to scottwelsh.me. Right on the homepage, there's a place where you can click and automatically give me your email, and I'll send you a free ebook. Isn't that a great deal? If you have any questions, of course, here's the information. It's a website. There's a Twitter. There's my email, only one T, and so on and so forth. All right, everybody, that's all for this week. We'll see you next time. Bye for now.